And yeah, this is what a distinguished crew. This is a real treat. AngelSpan's been around, well, 9 years now. In January was 9 years. My background is as a securities analyst and portfolio manager. And I ran a multifamily office, if you're familiar with that label. And in doing our own securities analysis, I was familiar with the sort of information that's available from data vendors that we would subscribe to allow me to take an objective view of evaluating companies. So I wasn't caught up in the optics of who the CEO was or what the industry was. So you don't get caught up in some of the things that where you lose objectivity, and you can make good risk-adjusted investment decisions with a degree of objectivity. That firm was out on Sand Hill Road in Menlo Park that I joined and eventually took over. And I was out there in the early 90s when all hell broke loose in angel and venture activity after the internet commercialized. And so I got very active in angel investing 30 years ago or 20, whatever years ago, 28 years ago. But from the view and lens of a institutionally rigorous money manager and securities analyst. And so that is sort of the origin story of what we created, is to create the equivalent of the objective data and performance analytics that I had access to as a money manager. We could pay for data like this to then do our securities analysis and build portfolios for our wealthy clients. And yet as an active angel, and my clients wanted me to help them do angel investing, I didn't have access to the information we needed. And so that's really how AngelSpan came about, was to really replicate the sort of rigors of both investment process, but access to objective performance analytics, but in this case, on private companies. And so that is always the objective. One of my key data vendor in managing money was a company, now it's a division of Credit Suisse. The CEO of that company, when they sold to Credit Suisse for $100 million, he hired me to manage his money. I was the best in the world at using that data. Well, he's also on the board of AngelSpan, because all we built in AngelSpan is trying to replicate what they built and eventually sold to Credit Suisse for $100 million. It's also that framework and that analysis is taught in this as part of the CFA curriculum. If you go through and get a CFA, you'll be taught their framework. Well, the core IP of this service, which I'm going to explain, this Bell Mason Diagnostic, has been recognized as having the same level of rigorous insights on private companies that company named Holt, now Credit Suisse Holt, has on public companies. That's taught as part of the CFA curriculum. So I would not be surprised over time as you see this Bell Mason framework become far more well-known than it is even today. It's well-known in the corporate venture world, quite actively, by the way. Craig, if Microsoft has a venture arm, I wouldn't be surprised if they're already familiar with the Bell Mason Diagnostic, because it's been used as a strategy consulting framework for the corporate VC world for over 20 years. And everybody and their dog that has a corporate VC activity has likely been exposed to the Bell Mason. Well, Gordon Bell, the principal architect, he's a Microsoft fellow, Craig. He's an investor in AngelSpan, and we licensed the Bell Mason to deliver the structure of those monthly updates you've all been seeing, but also it allows us to do the scoring that's captured and represented in this tear sheet that we're now going to go through. So that's sort of the origin story and the DNA behind it, and the goal and aspiration for what we have is to create, and we have created the first Wall Street quality performance analytics on private companies. So Alec, why don't you bring up WhisperSom's first tear sheet here. Okay, it's a 2-page document. Why don't you just scroll through it very quickly, or actually 3 pages, 2 pages of content. And then again, the last page is a little bit more specifics that I'll be going over as well on how these calculations, these illustrations were produced, links to the research, links to the Bell Mason Diagnostic. So the first page, again, in Wall Street terms, that's a common phrase for research and performance analysis on public companies. A tear sheet is a common phrase. And that's why I said we're modeling this after best practices in public market investing. The top of this is literally just to set the stage for what the content is that we're going to be going over. Okay, Smart IR is what we branded our scoring of clients' performance against the Bell Mason Diagnostic. That's part of the original diagnostic. But because that's a branded trademark framework, we can't use Bell Mason. So we call it SMART, which is an acronym for Standardized Monitoring, Analysis, Reporting, and Tracking of the Performance of Startups, SMART IR. And again, we're tracking our companies through 4 of the 5 stages of the Bell Mason Diagnostic. The 5th stage, there's a lot of companies that go public in the 3rd stage, by the way. These are all based on what you've built in the business, not funding rounds, but the stage of the business's maturation as the business is getting stood up off the ground. Sort of if you think of like how a building, when you watch a building get built, it's built up from the ground up. The Bell Mason tracks companies' progress from the ground up with the concept stage, being the idea on the napkin with a couple of people coming together. The seed stage, not associated with funding round, but the milestone accomplishments. Seed stage, what does that entail? The alpha stage. For years, the Bell Mason used to call the alpha stage the product development stage, but they associated alpha with A round funding because that in a traditional funding path for a startup, the A round is where you're building out that MVP that you've done a lot of the design work on. The beta stage used to be called the market development stage because after you've built the product and you're ready to bring it to market, you've got your pricing down, you've got your manufacturing, distribute, all the sort of things where the product is ready to bring to the market. The beta stage, the appropriate milestones are now get your sales force in place, right? Get your marketing really ramped up. So bring it to market. Now they call that beta stage associated with the B round financing. The fifth stage is called the liquidity stage, which is a company that's cash flow positive, profitable, growing with consistent margins, consistent profitability. Again, a lot of companies go public in the alpha stage. We only track 4 of the 5. We don't track that liquidity stage. Our client startups are gone before that. They're either public and they don't need us anymore. They got their own internal IR, or they've been bought, more likely being bought by somebody else well before that liquidity stage. So we don't even bother with it. Another component of what we're tracking is the transparency tell. Now that is the only thing that we've created internally. And it's simply a scoring on tracking how our clients use AngelSpan. Do they use it as we've coached them? There's research that's linked in here on that third page. There's a research report that was put out by the University of Leeds, working with a great deal of venture capital data, actual portfolio data, showing that CEOs that are properly and voluntarily transparent, not because investors are clamoring for better information from the startups, because that CEO already knows it's the right thing to do. It's part of their fiduciary responsibility when you take money from somebody else. They did a formal research showing there's an actual link between CEOs that have that mindset, that corporate governance and fiduciary mindset, with better performing startups. They were looking at a huge portfolio of actual data and actual behavior. And they did this report, came out and was published in TechCrunch, came out in 2020. So we realized, wait a second, that transparency, that voluntary gesture of being properly transparent, we actually score our clients because not all our clients are like Michael. We'll show you why they have a very high score of their transparency tell, which is a leading indicator of the eventual performance of the business as we score and capture through the smart IR scoring. So that transparency tell is what we've created simply to score our clients against 3 principal topics. The cadence of submitting information to us so we can curate and produce those monthly updates and do the scoring to produce this tear sheet. Are they giving us content across the full breadth of the Bell Mason, which our platform we built prompts them to? And our team of Alec and Nick are very good at drawing out information on these various topics that cover the entirety of the business, which we'll go into what those components are a little bit later. So cadence of submission to us. Don't wait till the end of the month like you're cramming for you got to write a term sheet or something, or term paper. Okay, give it to us throughout the month because we want to hear that granular activity, almost like what you report with each other. And then we capture that, score it against the Bell Mason, curate it, and produce that monthly update, and then eventually these tear sheets. Cadence, content across all the relevant topics of the Bell Mason, and then context. And this is really important. Context means, are they allowing us to do our job, or is the CEO trying to make their voice be what comes through? They put too many adjectives. They're maybe using too many buzzwords of the industry that's too specific and going to go over the heads of the readers. We're truly trying to curate this to optimize on the ability of the readers to grasp and capture what's going on inside the business without having to be an expert in that field. And also, we don't want it to look like a marketing piece where it's full of hyperbole or the CEO trying to project their own narcissistic personal brand through this communication. I fashioned this after Value Line. I think most of the people on this call are old enough, except for my team, to know who Value Line is or was. I used to read it in college. And every Value Line report was exactly the same. Or if you look at a Standard & Poor's tear sheet, the tone was exactly the same. It wasn't unique to the business or the CEO's voice. It was austere, it was crisp, it was focused. That's the context that we score our clients against. Do you let us make this optimal for your readers, or are you trying to make it a piece for your platform for you to put your voice out there? And we score them on 1 to 10, add those up, divide by 3, we have an average transparency score. That is highly correlated with what becomes their smart IR score, the Bell Mason performance. And again, the research is linked there. So that's the top piece. That's the background of what we're trying to produce. From here, it starts getting very company specific here. The company overview will speak for itself. This is a narrative that we extract right from their own materials. So this is the marketing efforts at framing exactly what, in this case, WhisperSom is doing. So it's just an overview. If you look at the narrative to the right of the circles, the beta, the concept, seed, alpha, and beta, that illustration, that narrative to the right is our interpretation of that illustration, which I will go through as well. So it's saying this is a seed stage company because they haven't exceeded all of the milestones to exit the seed stage. And I'll explain those details. So that narrative next to that illustration just is explaining the illustration to the left. On that shaded right-hand side, this is sort of an overview of just the company. Some of the folks involved, their access to who they are, talks about where they are if you go down to the key stats, when the company was launched, how many team members, shareholders, etc. You scroll down, and those October, November, December are the 3 links to their 3 monthly updates. So people that are seeing this tear sheet could also see where we got this information. What happened? They can look backwards very efficiently at the monthly updates that we've rolled up and then scored and captured in this tear sheet. Now let's go to that illustration because we get a lot of questions on this. This is where, when we've done these sort of presentations in the past, this is where most of the questions come. Clearly, they've hit all the milestones across the 4 main components. We call them the 4 pillars of that are the components of the Bell Mason: the team, the product, the market, and the operations. Those are the 4 pillars. Now, in the Bell Mason Diagnostic, each one of those 4 pillars has 3 subcategories. And all 3 of those subcategories have granular milestones associated with each of these stages. So think of a pyramid of milestones, but also staged across these natural life cycle stages of concept and seed and alpha and beta in our case. So they've accomplished all of the milestones associated with a seed stage company across all the 4 pillars. They got a full score. In the seed stage, they've accomplished approximately 58% of the milestones associated with the operational milestones for a seed stage company. You see that? 58% of the operations that's that light green. Not 58% of all the milestones they need to accomplish to be a self-sustaining business, but just the milestones for operations in the seed stage. It's really important. Now, the reason it says 58% is because there's 3 subcategories. And those subcategories have granular milestones. And we're giving them scores of 5 to 10. We'll give partial credit for accomplishing most of a milestone. But we average up all those milestones, the scores across all the milestones they've accomplished by reporting through us. And that average is 58%. So we don't want to imply that it's so granular that we're getting it accurate to multiple decimal places. We're not trying to be really accurate on the milestones, on the score. We're trying to be consistent of making sure they're getting all the points they deserve in a consistent way as they keep building the business. So readers can track this change over time to see the value creation, almost like you're watching a building get built from the ground up. This is a way to see this, the components of the business all getting built across the stages. Okay, in the market section, now again, let me break down some of the subcomponents just to give you a flavor. Under team, the subcomponents of team is the internal leadership team, which you've seen good representation on this call. The internal operating team, people that aren't in the C-suite, if you will. And then the external leadership team, advisory board and board of directors. Those are all the 3 subcomponents of team. And as an example, a board of directors. You don't need a board of directors for a concept stage company. So that's not an operational milestone for a concept to get through the concept stage in that team component. But it's very relevant when you start raising money through the seed round to have a board of directors, corporate governance and oversight. Okay, so those are milestone accomplishments. Having an advisory board, that's appropriate for late stage concept and seed. Okay, you can phase out your advisory board as the company gets more mature, because that's oftentimes driven by the board of directors activities with the CEO and the C-suite. So this is just to give you a picture for why the timing of the milestone and the timing of this granular components is very relevant to earn these points that we're capturing and scoring here and trying to represent. Under market is what is the vision you're going after, in this case, sleep apnea, and the impact it has on what you call hypoxia, I believe, if I'm using that word correctly, absence of oxygen. That health condition broadly defined. That's the marketplace you're going after. But there's also marketing and sales as subcomponents of market. So the very market you're going after, and then your marketing and sales efforts, and then granular milestones associated with what you should be doing to build out those components across concept, seed, and all four dimensions here. Operations, it's the finance operation, meaning funding, accounting, and legal. Those are the three subcomponents of operations. And then product is, can you build it? Can you protect it? And can you distribute it? Deliver it, right? And this is where under product development, we've had some conversations with Michael about, he feels the product development is further along. And we're saying, well, it's not ready to go to market yet. You still got the FDA approval. So it's not market ready yet. And that's why that's one of the major components left to earn the points on the product development. In this case, it's in the alpha stage. They're way ahead of the product development, and the team is way ahead of the operations and the market. And that's for logical reasons. MedTech products with the FDA approval, the development, the R&D that takes place, that's not uncommon. We see that across our other biotech companies and some others, is that the product development cycles are longer. So you can stay in that alpha stage for a long time until you maybe get FDA approval or the things you might need, regulatory approvals you might need. A CPG company, for example, you could have product development happen at a few farmers markets and people love your product. The next thing you know, you productize it, trying to scale your business. So product development cycles are collapsed in CPG companies and long for biotech and medtech. So the time component that you stay in these are very specific to the company and the business model and the industry they're in. But this is an objective framework to understand that and start that additional analysis so you can level set in understanding the company and where they're at, where their money might be spent in a financing raise, building out the operations, building out the marketing and sales, getting ready for that FDA approval. So it's an easy way to show potential investors, look, we're raising money because these are the milestones we're going to spend that money on to accomplish, to catch up with, in this case, the team's in place. The product is just, we're pushing this through the FDA, and now we're raising money to start building out the rest of the infrastructure to get ready once it gets FDA approval. So there's no right or wrong answer, but this objective way to view this is a context to both ask informed questions as an investor, potential investor, and also in the case of a fundraising round, to give context to what are you raising the money for? Where are you going to spend it? It just gives logic and a framework. And the goal, obviously, is confidence as to where the money's going to go. Common question a lot of people have is, the issue of product market fit. You built too much time on the product without softening the marketplace, particularly if it's something new. Well, sleep apnea has been well developed. This is just new technology to solve an existing problem that's not being served as well as it could be. And that presents the opportunity for this. And they're being very smart to get it through the FDA before they spend a lot of marketing dollars before they have a product to take to market. So again, the imbalance in this case between product and market is sound business decisions. It's not a mistake. If you're a software vendor or building a SaaS product, that's a real risk. You spend way too much time building the product before you actually go talk to the marketplace to see if the marketplace even cares. And that's where product market fit becomes a risk. In this case, it's prudent capital allocation and focus. So that's my point, is that this is built for investors to be able to have an objective, contextualized way to really understand the business far more than just what you would get through an exec summary or a pitch deck, and to appeal to a more sophisticated investor that's going to understand this and get it. They're going to understand the marketplace. That's not our job. That's Michael's job and the team's job to talk about the opportunity to improve treatment of sleep apnea and all the other indications that hypoxia causes. That's you framing the opportunity, and that's your expertise. Our expertise is understanding where the business is and being able to represent it properly and objectively. I'll stop there very quickly, force any questions. We don't want to keep this completely just a canned presentation. So is there any questions that would like some clarity on this, or you'd like to inject some comments? Anybody? Nobody? Okay, well, we'll move on. Alec, why don't you go to the next page?
I actually believe Dr. Craig had a question himself. He's just on mute, I believe.
Craig, you're muted. Can you hear us? There you go.
There we go.
Sorry, Craig.
My mute button just had vanished and it just reappeared. So I assumed that maybe, with a lot of participants on the call, sometimes the mute controls are taken over by whoever runs the call. So first of all, thank you for that. It was great to hear. It made a lot of things make sense to me that had not made sense to me before when I had been hearing about some of this stuff. So for example, the way I would tend to think about something like this is as if it's a scorecard where, you need to race to get the higher scores and advance. It's like a horse race. All of those things need to go. But clearly, for example, we've made strategic decisions not to invest in developing the market because since we're not able to take advantage of any development we put in, if we create a lot of excitement around the idea of non-invasive neurostimulatory therapies, all that does is it invites big players to start to investigate and invest, earlier than they would.
Exactly.
So we have chosen not to do that. Where does somebody get the context that would explain the decision-making that led to this representation of our position? Is that a completely unrelated document that this might be included in a packet that would have other documents? Or is there something about, because this document has things below it, the monthly updates below it, those are live, places you can click. Is there something else within the universe of this document that would represent management's explanation of why we're positioned this way?
No, and that's intentional as well, because this is meant to be a supporting document for those exact conversations. Now, in sending this out, this is innovation in how startups communicate to the outside world of existing potential investors. That's why we do these recorded presentations for exactly this. If somebody sees this for the first time without having an in-depth conversation with you or Michael about that strategy you just articulated, they can hear your comments now off the recording, or God forbid, the better thing is to just have a one-on-one conversation to explain it and say that was a conscious choice. We're not stealth, but we are, right? We did not want to attract a lot of big players until we got in the marketplace. So that was an intentional corporate decision. That doesn't mean we don't have product market fit and we were distracted by getting too excited over the product. No, that was a conscious choice and a smart one.
That makes sense. How do you deal with the problem of language mismatch across disciplines? What I mean by that is the concept of seed, I think, really sort of comes out of the financial investment community. And so we all know how to value a word like seed. But terms like alpha and beta really come out of different industries, and they mean different things in different industries. And in no industry that I'm familiar with does the term alpha mean that your product is not yet in production, right? In other words, explicitly, alpha means something completely different, and we would expect that that a product would go through multiple beta phases before it was ready for production. It would go through maybe 2 to 3 betas, and then it would go through production engineering, and then it would be ready for production. So when something gets labeled alpha, you can see what's going on in Michael's mind, for example. And I've only really heard this through Michael, but you can see why he would think that this is that the amount of development and progress has been undervalued, because nobody would call this an alpha. In the worlds in which I operate, and yet I understand absolutely that it belongs there in this world.
Yeah, Craig, this is again clearly you're a brilliant man, and Michael made that clear beforehand, and we understood that beforehand. But this is our challenge, because again, I'm sure Gordon Bell is equally frustrated with some of your frustrations, because what's completely lacking in the world of venture capital and startup nomenclature is standardization.
Right.
Even term sheets, or a lot of there's an absence of standardization. And Gordon is a scientist. If you look at his background, he's the first winner of the John Newman Award, which is he's a rock star. And this is a guy who understands how to improve systems and systems design, and standardization and nomenclature is critical for efficient activities within a system, right? People have to be speaking the same language. And yet today there is no standardized language. Seed round, pre-seed round, that's all noise in startup land. And so it's our challenge to start building a greater familiarity with the use of alpha and beta in the context of the stage of the business life cycle, not a product life cycle or product testing life cycle, but a business maturation life cycle. And that's what Heidi Mason's been communicating this to the corporate venture world for a long time. So they're well familiar with this nomenclature because they've been using the Bell Mason for 2 decades in corporate venture activity. Right. This is part of our roadmap of our challenge from a marketing and education standpoint, is saying, look at pre-seed or seed, those are random labels. These are not random labels. These are based on very specific milestones. And yeah, they chose alpha and beta. Yeah, there's some bleed over and there's some confusion, but it's an important thing to separate because it draws proper relief, I think, to the randomness of the other labels that are oftentimes better around and people are comfortable with. Oh, this is a pre-seed round. The hell does that mean?
Yeah. Yeah, that all makes sense to me. You can see perhaps why I might, if I were going to be needing to show this to somebody, I can't include this in anything, right? I could never show this to anybody. They would assume that I was stating that the product was in alpha, and to have that kind of conversation. Now, maybe if this document had a list of, what are the requirements to get out of alpha and into beta? To be a beta, you have to be a production.
Right.
Well, I mean, right. There isn't really anything. I see you talked about it and it's way down here, and yet, man, the damage is done when you show somebody something that, is really, we think the data that we're collecting right now should get us the FDA to give us a designation as breakthrough technology. That's a lot of effort and a lot of work. And
sure,
the story for those who've been involved or might be getting ready to get involved just feels like, it doesn't feel like that's where it is. You get it, right?
Oh, absolutely.
How do other people deal with that? How have other people approached that or solved that problem? Because, obviously this looks like a great thing.
Well, again, partly why we're doing these recordings, Craig, is we're trying to help arm you with the content. If somebody has confusion, you could say, let us get our IR department on the phone. And you get me on the phone. I'll talk one-on-one with them. If there is, you shouldn't have to bear shoulder the burden of trying to explain all this. That's why you've got an outsourced IR department to explain it for you. That's why we do these recordings. And so that is my suggested way to handle it, is don't get in the weeds on it. Back up and say, you're right, whoever's having some confusion. This is not about the product development. This is about the business development, rigorous stages that's done through this rigorous framework. Let us have our IR department explain this to you. And then you can hand it off. So you don't get in the weeds and get caught up in that conversation. You could keep talking about exactly what you just said. This has taken a lot of time. We put a lot of effort in this thing. And what's going to happen is that product development is going to go right up to beta fairly quickly once we get our pricing sorted out. Because that's one of the key points to leave alpha, is not only can you deliver it, but do you have a pricing model that has sustainable margins, and then the beta stage is where you're now taking it to market with that pricing model already built, and you can deliver it, and you're building the go-to-market infrastructure, sales and distribution channels and all those sorts of things. So this is a rigorous framework it's like GAAP accounting as well. GAAP accounting is a foundation to do further conversation and analysis on top of, but it's not the end game. The Bell Mason isn't the end game, but it's absolutely as good as it gets as a foundation to do insightful analysis and conversation on top of.
I hear you. Yeah, too bad. If you ever get any revisions on that, just make it stage 1, stage 2, and we'll be, everybody will be fine.
That's an interesting comment, and we'll take that under advisement, because we don't use the Bell Mason language. We call it Smart IR. We are adhering to, so people, if they are familiar, because we have links to Bell Mason, people can. In fact, as Alec was scrolling down, there is links to the Bell Mason that goes into much more granular description of the stages and what it takes and all that sort of stuff, and what's the alpha and beta. So there is links to that. And I agree with you. This is not marketing. This is not easy. This takes a little bit of critical thinking, a little bit of patience, and it is new. And that in and of itself is hard. Anything that's innovative is hard. And this is an innovative way to communicate the stages and maturation of a startup. So yeah, apologies for that, and apologies for the background noise too. So, so now we're starting to get to the representation of longitudinal performance. So that first page was the snapshot up through when this was produced, through to the December update. Now, as time goes on and we produce each incremental monthly update, we're going to add blue bars because we needed 3 months to compute the first bar to get triangulation to get that score in place. But every month now, that bar will likely go up, showing the incremental milestones that were accomplished for the month of January and then February. So we can see a trend of value creation as more blue bars show up and each one is higher than the prior one. And that's a really key part of as a securities analyst, a snapshot of data, looking at income statement and balance sheet gave you a good snapshot. But to do securities analysis, you need to just track the change in data over time. Now it becomes a living, breathing organism, and you can see where it's at and the momentum of the business and what's happening inside the business when you're analyzing data over time, as long as the data is rigorous and standardized. So you can trust and you can compare month over month and quarter over quarter. And so that's what this is representing. The bar is the score against the Bell Mason, the Smart IR score. The little green line where we have 3 data points is that transparency score. Anything above 6 is good. As we've looked at a lot of our clients, anything above 6 is good on average. Okay, we're averaging across cadence, content, and context, giving them 10 points for each, dividing by 3, adding them up, dividing by 3 to get an average score each month. Oftentimes we see the score drop during the holidays because they just don't report during the holidays. Nobody's reading it and the clients are busy. Score could drop that month, but it comes right back up the next month. So this is, again, above 6 is good. Above 8 is rock star. Okay. Nobody gets 10. We do. AngelSpan uses our own service. We don't have a 10 score. Okay. So again, this is context to elicit, to give the investors, again, the confidence to know they're going to be able to very efficiently track the momentum, see the commitment to transparency, because what we have found over time, we've worked with over 500 startups now over the last 9 years, is that green line, that transparency score, is a leading indicator. If they stop communicating, that means stuff's not going well. If that drop off in communication is happening, it's not happening around the holidays. It's the canary in the coal mine. Also, if it's a consistently high score, you're going to see that Bell Mason or Smart IR score really do well. The velocity of traction, the velocity of execution of that team will continually be strong. But the transparency tell is the leading indicator. And for investors, that's really important. Because if a tear sheet comes out where the score went down, now that you've got something really specific and interesting to talk about. Why did your communication drop? What's going on? Why did the communication drop off? Okay. So that's what that upper, and then the narrative on the right is just our interpreting and explaining much what I just did for this recorded presentation, but that's in every quarterly tear sheet. There will be an interpretation of the data in that right-hand side narrative that'll be available for the readers as these come out quarterly. Now, as you're scrolling down, Craig, this is a little bit, and we get this all the time. Part of our agreement with the Bell Mason Group to license this was we can't give away the granular milestones. But we also didn't want this clients to gamify it. Tell us what we want to hear to get the points to show themselves well, right? We didn't want the bullshitters. This is our point of basically sort of lifting back the veil on the Bell Mason milestones. Under product, what are the components that are necessary to earn more points? So we're basically saying, once you accomplish that, more points are coming. That's the nearest term milestone you've not met in that product, in this case, in the seed stage of the company. Under market, a couple more there. And these are all specific to the stage that company is in that area. Product, it's in the alpha stage. Under team and under market and operations, it was still in the seed stage. So these are seed stage milestones that have yet to be satisfied for WhisperSom. And when they do, they'll get those points, and that will keep moving through the natural life cycle stages. So this is our way of saying, trying to nudge them and draw them into doing, kind of focusing on these things, because when you do, you're going to get the points, and that's most relevant. Don't keep doing stuff you've already earned points on, or do stuff that's not appropriate for your life cycle stage. Stuff that's kind of fun to talk about, but it's for much later stage companies. And that's where we actually give the clients a little bit of a view on, this is where you may want to focus on. And then going down further, this bubble chart, and this is going to morph for us over time. This is our clients to date, all of our clients to date. Okay. The color of the bubble is associated with that stage. Concept is red, seed is green, alpha stage, yellow, of course. Beta stage is the black. I'm not sure why we got that NA. We've got a funny quirk there in our program there. The size of that colored bubble is how many points they've earned inside that stage. So you'll see some green bubbles bigger than other green bubbles because they have more seed stage points. Now, over time, as we have a greater and greater database, we'll start producing bubble charts in the case for WhisperSom for MedTech, our MedTech clients. So they can start comparing a little bit more peer-to-peer comparison. And the more robust our database gets, the more granular we can isolate so clients can truly see just seed stage companies that are MedTech and maybe in North America or in that indication or in that field. Forgive me for the noise. So that's what that bubble chart represents. What you'll see with WhisperSom, the x-axis is that change in that smart IR, the blue bars above, the change in those points over time. Because what we can track is the velocity of traction. The faster those bars go up on a month-to-month, that means that team is executing at a faster tempo. That's a way to put data to show quality management. They've chosen to be in this business. They've chosen to pursue FDA approval. How fast you can hit those milestones is a reflection on the quality of the management. So this is where I had investors come to me for years saying, you have inside information on startups. Tell me about your best clients. Till I had enough data to communicate it, I didn't want to say I agree with the business idea. I want to show with data, quality management, commitment to transparency, because that's highly likely to execute well. The idea itself is, I don't know if it's a good idea or not. That's not my job. So this is our way of saying, look at our best clients are those that are in that upper right-hand quadrant where that x-axis shows the highest velocity of traction. The further to the right, the highest velocity of traction. The further up on the y-axis, the greater commitment to transparency. That's their transparency score on average. And so the upper right quadrant is our best clients. Now, over time, our own platform will start tracking the movement of these bubbles. Sometimes you could be way upper right, but you're drifting down left. That's not good. Where you may not quite be in the upper right quadrant, but with a bullet, you're moving forward. And anybody that's like WhisperSom that's on the y-axis, that just means we don't have 2 or 3 months to track velocity. So that's not a commentary on their velocity at all. It just shows they're a new client for AngelSpan. Okay. So this is our way of representing it. And again, over time, it's going to give context for the investors and context for our entrepreneurs, particularly those like WhisperSom that are showing a commitment to transparency, and the velocity will come out over time. And they'll say, that's us over there. We're one of AngelSpan's best clients. And I can validate that with data, not because I'm commenting on the size of markets and the protection of the IP and all that. No, that's not. It's with data. Okay. And again, there is a narrative on the left-hand side to explain all that for the readers that don't want to go through the time listening through this presentation. The third page is, again, getting granular. We're in the business of transparency, and we like to give more information rather than less. We don't like to dumb things down. We actually make things a bit complicated, but I like research. I like content. I want to be able to think for myself, and we want to respect the readers. And so this has links to the Bell Mason Diagnostic. It explains the transparency score. It talks about all the things I just spoke of above and explaining it. So if people really want to understand, they can actually do their own homework. Or, as you said, Craig, if it's somebody that's just still scratching their head on that original chart, you can say, let's get AngelSpan on the phone. We'll handle that too. Because we want to appeal to people that want to do their own thinking, or they've studied it, they don't get it, finally call us, because we're part of the team of all of our clients to explain to investors. My background, I've been on the board of public companies. I'm a valuation expert. I was hired specifically on that company because that company was its largest asset was an investment in a private company, and I'm a valuation expert. Securities analyst. I've been an active angel investor, managed lots and lots of money, very sophisticated folks, and recognized as such. I can speak to just about as sophisticated investor as you can bring to the table for me to speak to explain this, to talk about why this is a better deal from a risk management standpoint. That's my job. And firms like Craig, WhisperSom and Michael, again, Michael's story is even better than many of ours because he was already committed to transparency before he hired us. That's even a better story for me to tell. Clearly, the research shows he was not only committed to transparency, but when he saw an opportunity to even elevate his game, he hired us. That's a huge reflection on Michael. It's a huge reflection on Michael. I can't tell you how many startups, well, I'm already doing it. Well, they're also trying to control the narrative, or they might be narcissists and they're trying to inject themselves so they can get the credit for it. That's not Michael. He was doing it, and he was doing it well. He already has a document vault. He has a data vault for investors. He's got his corporate governance and act together. And yet when he had an opportunity to elevate his game in transparency and reporting, he jumped on it. That's a huge testament. That's supported by that research that shows the link between proper voluntary transparency and success. Michael was good. He wanted to be better. It's a huge testament. And I'm speaking with a lot of experience, talking to a lot of entrepreneurs. Most entrepreneurs don't even want to do this. It scares them. They're hoping that a demo day and a sales pitch is going to be enough to attract somebody's limbic brain to get excited about something, and then have that sort of hangover after the fact. Oh my God, what did I invest in again? I never hear from him. I forgot. What was that again? Why did I do that? That's why a lot of entrepreneurs are trying to source capital these days. That's the way the system has been built. We're trying to elevate it. We're trying to elevate the system to raise the expectation of entrepreneurs. If they're serious, trying to attract money from serious investors, they've got to elevate their game of corporate governance and transparency. And we're the service to help them do it, as Michael has embraced. But investors need to elevate their game as well. They need to be a bit more thoughtful on how and why they're investing, and think a little bit more about risk management. Absolutely. You got to care about what they're solving. It has to resonate for you. But also, you should expect transparency, so you're not just throwing money around. And that's why this is a worthy opportunity to invest in, to be part of a venture portfolio. And I don't know anything about sleep apnea, other than my father used to snore oil. So with that, I know it's getting a little bit chattery here, and I apologize. I am at a conference here, and this is the quietest room I could have access to. But anyway, I'd like to put myself on mute and hand it back to Michael to wrap up.
Good, Joe. Thank you so much. And thanks everybody on the call for participating. I should say on the Zoom meeting. Does anybody have any questions while we have Joe here with us? If we've got a couple more minutes, now would be a good time to ask them. Or we can take it offline, your choice. But Joe is here for us right now, and I wanted to give you all an opportunity to, as Craig has, take an opportunity to ask anything you want.
And it's quieted down here a lot.
Okay, I don't think anybody's trying. I don't see anybody trying to talk with a mute on.
I do have one more question. I'm sorry for monopolizing this, but the opportunity to learn from you, Joe, is very important to me here. It seems clear that people who see this will use it not only as a framework through which to think about a company and how a company is doing, but also to judge the progress that a company is making, assuming that they understand where all of these things are. As with, okay, it's not a public security, but still changes over time are really more important than where something starts. You got it at some price and you want to know what's happening. And I'm a little bit concerned about how well something like this can fit in terms of granularity with all of the different industries that might have to be represented, service companies and product companies and automotive companies versus small plastic widget companies. There's just so many differences amongst them. And so an example of what I would say might be a low goodness of fit score would be something where essentially your progress requires you in marketing, let's say, requires you to approach and hit milestones that you might be choosing not to approach. So it therefore looks like you're making no progress. In other words, there's nothing you can do to show that you are internally ready, or that you understand what I'm saying. The indicators seem to be external engagement indicators. Marketing. I mean, an internal go-to-market plan that's fully fleshed out, for example, is more valuable than engaging an external company that doesn't know you, that is going to take you to market. They still have to go through all the development of the go-to-market work. So the actual work is done, yet you don't get credit for it till you engage the external company. I'm not saying that to be a fact. I'm raising it as more of a query. And similarly, the work that we have to do on product is likely not going to be visible. In other words, maybe the FDA stuff will be visible. We'll get some points for that. But a lot of the stuff that we're doing, which is competitive positioning product-wise and things of this kind, and product revisions, there's a lot of work going on, and yet no progress will show for a lot of that. How do you recommend that a company using this deal with that? And I mean, other than simply saying, call Joe and he'll explain it to you.
Well, actually, yeah, Craig, specifically to that product thing, part of the subcategory under the product section is the strategy itself, right? So actually speaking to that and actually just being transparent in what your efforts are and how you're, placing yourself in the market, like that'll show up in points, in my experience.
And yet we're going to be on a bubble chart, with a low velocity until we're ready to do these things. And suddenly it's going to jump. So in other words, I'm questioning whether it's granular enough or whether there needs to be a specifically more granular layer that there's something that's grafted on or that's a good fit for this, that's a more granular layer that shows all the stuff before you hit the milestone.
Well,
Craig,
I was going to say,
can I interject, please?
Yeah.
Because I've been thinking about this very subject myself. There's a lot under the hood that is sort of difficult to explain, but it's explainable. In other words, we could develop sort of like the granularity of milestones, meaning things that we know we have left to do that are, coding and factoring and, stuff that isn't showing, doesn't make your product the next version necessarily, but, perhaps takes care of some technical debt, which has to be done and is part of the product development that we could call out as needing to be done and then tell you if we've got it done or not, over time.
Well, I'm asking more for I understand how we can tell our story. We tell our story, I think, reasonably well. If somebody sits down and spends the time, they come away. Don't know whether they're impressed or not, but their understanding is pretty close to the understanding I would hope that they would have. And that's the best that if that fits their needs, then that's great. And if it doesn't, I fully understand that. We're pretty proud of the progress that we've made. So I'm not so worried about that. I'm wondering what other companies are doing about this, because we know we're not going to be the only ones that are that way. It's like, for example, on this sheet somewhere, I saw some comment about the work necessary to integrate our data with the data of a sleep lab when we go into a sleep lab so that the scoring can be unified scoring. So this was a late recognized task, was an add-on to our product. It required an external box for the field versions because it has to go out into a harsh environment in a sleep lab. You don't know what it's going to get connected to. You can't be bringing. You have to have isolation for the patient and also isolation for your product. So bidirectional isolation and all this stuff. So there's a lot of work in there and there's a lot of value in it once you realize that it's got to be a part of the product. So you folks called that out. And yet that can't possibly be a part of your actual scoring of how you achieve milestones, right? That's not going to be anybody else's milestone, just ours. That's where I'm getting at, around the granularity of you're calling out stuff that needs to get done and we're going to do it. It won't advance the score, even though it's a milestone that gets hit. So does it just appear in the narrative there and then disappear when it's done, or?
Well, I'm not sure, and this will go to Nick and Alec. That granular narrative has obviously come from some of the things that Michael's given to us on what we're working on. Right. But I'm sure, and I'll let Alec and Nick answer this, that's associated with a product development or go-to-market milestone. Those are just the granular descriptions specific to your product, but that rolls right up into a natural label that is a Bell Mason Diagnostic milestone. Okay. Another company might be, we need to, if it's a CPG company, we need to get our co-packers cleanliness proper so they can make our product at scale for us.
Right.
But it's still the same thing, right? It's still, can you deliver the product or can you deliver, right? So that's a specific language that we didn't extract, of course, and no, it's not in the Bell Mason, but it rolls right into a natural Bell Mason milestone, without a doubt. But to your earlier question, Craig, and this is a really important point, and this is where I continually try to speak from an investor's perspective. Okay, you're an inventor's perspective, you're a scientist's perspective. You do understand how hard this is. And yes, it takes work. But you know what? Investors also know that medtech takes longer. But the good news is if you make it through FDA, you've got patent protection for a long period of time. They can monetize all that hard work over a long period of time. They make those calculations. CPG companies has no defensible product other than brand, and those can go away in a heartbeat. But a lot of their spend is developing a brand. Their products aren't that unique from the other food products or beverage products. And that brand can disappear like that, where yours has patent protection. So investors make those calculations. You don't need to be as sensitive about those calculations, because investors, if they're smart enough, if they're a medtech investor, they already know that. That's why they're a medtech investor.
Right.
So they're going to be far more patient about this interpretation than you think they are. You may be a little more sensitive to it. The other answer is that, again, I always go back to the same thing. As a securities analyst, I knew GAAP accounting was useless, almost useless. But you had to have a standard representation of their performance across any industry at any stage of that small cap, large cap, growth, value, turnaround. You had to have a level set starting point to do industry and then company specific analysis. And that's what this represents. We're not trying to be the end all. We're not trying to answer every question to get everything perfectly right, because as you know, perfect is the enemy of good. And this is not just good, it's better than anything else out there, because there is anything else out there. It's not trying to be perfect at every client, every business model, at every point in time, because that's a false goal anyway. Okay? Because investors, if they're investing properly, they're going to know this. If they're medtech, they know everything I just described. You've got patent protection. They understand what a milestone that is. They know how hard it is to get through that. So they can empathize with you. Our job isn't to empathize with you. Our job is to give them a standardized framework by which they can very efficiently make their decisions and confidently. And that's the point.
So the granular list of things that are connected to milestones that roll up into the score, or that address a milestone, where do those live? Where does that list of things live? Like when a new one is recognized, a new essential element of work is recognized, you know about it because we told you about it. Where do you put that and store that? Is there?
Oh, that's a great question. One of the things we can do, Michael, I would love to do this. This is where I can become a real nerd. But we can stop the sharing of the tear sheet and show you the back end and the audit trail and the actual scoring and the notes associated with every point and every score. We've got a full audit trail, and it's in a database we can show anybody. So it might be a little bit too much for this one call or this one recorded presentation, but I'm happy to show that to you, Craig, because that's something I'm really proud of.
I'd be very excited to see that. As a data guy,
it's fun. Yeah.
In healthcare, that's the way I would prefer to spend my geek out time.
Well, I'm a nerd too, and trust me, this is the fun stuff. And we'll take individual clients through this and say, look, if you don't think you got all the points, tell us why. And then we'll go, and we've taken points away from clients. If it's a CPG company that has to go through a rebranding and repackaging, that's their principal IP. We take points away of product development because they have to rebrand it.
Yes.
Okay? And we have an audit trail of that.
Yes, it's the connections that make that work that are very interesting to me, to understand how we relate to, how we as individuals working on different aspects of this company, how what we do ties back to and feeds into the way our company appears. And
Yeah, absolutely. I think maybe we do that offline at another time where we can just maybe carve out an hour and I don't have the noisy background to
that would be that would be great. I certainly would prefer to defer that to another time, but I'd like to do it. Thank you. Yeah,
it'd be fun. I'd welcome, and anybody else that would be welcome, obviously, Michael. So if anybody that listens to this or anybody else on the call, you're all welcome. Because that's where I like to take folks, to let them really understand just how really detailed and the authenticity and the integrity of the consistency of the score. Because again, it doesn't even have to be an accurate score. As long as the scoring is consistent, it's the change in the data over time is where the insights come.
Right.
And that is the point.
It's legitimate hard work that, largely, our chief scientist and medical director, Dr. Fiat has been doing. And it's a lot of heavy lifting, and it's hard to see that and express that to people. unless I really take them under the hood and show them what's been built, and that's a whole, that's not, you can't put that in an investor deck. You need.
No, you can't. And the thing that's really important and how this rolls up is your pre-money and post-money valuation. All that hard work is associated with that pre-money valuation and the amount of money you're going to raise.
Yeah.
That's the evidence. That is the evidence.
Well, and particularly if we're going, looking at it from a replacement cost standpoint.
Exactly.
Because that is the evidence for, all right, here's what we built. What do you think it would cost to replicate this?
Yeah, good luck.
Forget the IP. We're just talking about, the work that's been done to make this thing do what it does, which is remarkable.
That's exactly right. And the opportunity set of being prepared right now to go after the marketplace as big as it is with the timeliness, because anybody else that would try and either buy you or try and do it themselves, time is not their friend for the very reason Craig mentioned earlier. That time has value. The time you've already spent has huge value. To be in this position before the world really realizes the technology you built and the opportunity to go grab the market share and to go solve the problem better and become a very valuable business from here. And that time, while it was hard work, it took a lot of time, that's an asset.
Well, Joe, when I met you, I think one of the first things you said is that part of what you are doing is helping an investor understand the intent of management.
Yep.
By looking at what they've done over time and showing a track record and a pattern of behavior that's consistent.
Exactly. That makes you a less risky investment than the typical demo day pitch process or some hot deal somebody told them about. Absolutely.
So at any rate, I really appreciate your time today. Thank you for meeting with us and explaining this.